The financial massacre has already started, and it is wearing a friendly mask. They are calling it stability. They are calling it a soft landing. They are calling it progress. Meanwhile, you are losing purchasing power. Your rent is still climbing, and your wages feel like they are stuck in mud while the stock market keeps hitting fresh highs. And here is the part nobody wants to say out loud. The collapse is not random. It is engineered through incentives, through currency moves, through interest rate policy, and through a global system that quietly transfers risk from the people who earn money every day to the institutions that can survive any storm. In 2026, you are watching it play out in real time, and the scariest truth is this: the people at the center of the machine always know the next step before you even see the first warning light. This is not financial advice, this is financial education, and the goal is simple. You should understand how money really moves when the headlines say nothing to worry about. You should recognize the mechanics that trap ordinary people. And you should stop trusting the story you were sold, because the story has been wrong for years, and it is wrong in a very specific way. Let's start with a reality check. In 2026, most Americans, Britons, Canadians, Australians, and Europeans feel three things at once. Jobs are changing faster than anyone trained for. Artificial intelligence is not just replacing tasks, it is replacing entire job categories, especially the middle. Housing is detached from wages, which means a generation will rent forever or move far away from opportunity and still pay too much. And inflation may be down on paper, but your actual life still costs more than it did in 2019. Even if the consumer price index stabilizes, your grocery bill, your insurance bill, your healthcare bills, your energy bills, and your rent rarely go backward. Now add the fourth pressure. Wealth concentration keeps accelerating. The top 1% owns more than they did a decade ago, while most households are quietly bleeding out. And the market is telling a story with different characters than the one you live in. Stocks recover, corporate earnings look fine, and investors talk like everything is normal. But for people with real bills, normal is not what they feel. Normal is a job that keeps getting smaller, a savings account that stops growing, and a credit card that starts doing the work of a paycheck. So what is happening underneath all that? Currency war. Not the cartoon version, the real version. The version where central banks set interest rates, where governments use tariffs and policy pressure, and where capital flows chase safety and yield. When that flow flips direction, the exchange rates move. When exchange rates move, it changes the cost of imported goods. It changes the value of foreign assets, and it changes who eats losses and who gets protected. You might think tariffs are the main weapon. They are not. Tariffs are the noise machine. The real battlefield is the exchange rate and the bond market plumbing behind it. If you want proof, watch what happens when a currency suddenly rises sharply. Everyone with assets in that currency benefits in one direction, and everyone with liabilities and export dependency suffers in another. That is not a slogan. That is an accounting identity. It is arithmetic. Pattern interrupt. Picture a country that relies on exporting manufactured goods to the United States. Over 20% of its shipments go to the U.S. Its currency has been weaker for years. Its companies and insurers hold large sums of U.S. assets because U.S. bonds are considered safe and U.S. markets offer yield. Then suddenly, in a couple days, the currency spikes. 10%. 10% in 2 days is not a move. It is a shock. And sure, if you are a consumer traveling or shopping abroad, a stronger currency feels like good news. Your imports get cheaper. Your dinner out feels like a discount. People laugh at those earlier worries and post memes about saving 10%. But the companies that sell into the US do not get to laugh. They get to bleed. If the currency strengthens, their products become more expensive for the US buyer unless they cut prices. If they cut prices, margins get crushed. If margins get crushed, layoffs start. If layoffs start, demand falls. And if demand falls, investors stop funding new projects. Now the tricky part is what happens to the US investments sitting on the balance sheets of local insurers and pension-style institutions. Their assets in US dollars revalue when they convert back. Sounds good, right? The currency rising would increase the local currency value of dollar assets. But the trap is in the timing and in liquidity pressure. If the insurers had to sell those dollar assets to meet policyholder withdrawals or regulatory capital requirements, the exchange rate move can create a feedback loop that forces even more selling. Here is where the story gets ugly. The stronger currency move is not always a celebration. It can be a result of forced selling of dollars. If local institutions panic, they sell dollars to raise local currency liquidity. That selling pushes the exchange rate higher. Higher exchange rates then cause additional losses or capital strain for the institutions that still hold long positions in dollars and need to rebalance. That pushes the system into a spiral. You can feel this logic in your own life, even if you do not trade currencies. When a market moves quickly, it stops being about fundamentals and becomes about liquidity. Liquidity is the oxygen of finance. If institutions cannot obtain it without selling assets at the wrong time, the losses are real, and the losses do not care how smart the long-term plan sounded last year. So let's map this to 2026. This year, many people think they are safe because they are not running complicated trades, but the currency system touches everything. If your currency strengthens, imported goods can get cheaper and local asset holders might feel wealthier. If your currency weakens, everything gets more expensive. Either way, your wages do not adjust instantly. Bills adjust immediately. Meanwhile, the Federal Reserve is doing what central banks always do when they face a choice between fighting inflation and preventing financial stress. It changes interest rates, and it changes the cost of borrowing. But the real effect on you is not the headline interest rate. The real effect is what happens to mortgage rates, credit card rates, auto loan rates, student loans, and the prices of the assets that back the financial system. Pattern interrupt again. Imagine your mortgage. You finally got a rate. You finally got a payment you could tolerate. Then the market expectation changes. Not because you did anything wrong. Because a bond market repriced risk and the central bank signaled a different path for rates. Your payment changes or your refinance options disappear. That is not politics. That is bond math. That is yield chasing. Now connect that to currency warfare. If the United States offers relatively higher yields, capital flows toward the dollar. That can strengthen the dollar. A stronger dollar makes foreign currencies weaker. Weaker foreign currencies raise the local cost of servicing dollar debts and the local cost of importing energy and commodities. But in 2026, you are also seeing something else. Many global investors do not just hold stocks and bonds, they hold currency exposure, they hedge sometimes, and sometimes they fail to hedge enough. When volatility spikes, hedges get expensive and margin calls hit. That is when the system forces sales. That is when exchange rates jump. And when exchange rates jump, it does not only punish exporters or borrowers, it also punishes the institutions that built their strategies around assumptions of stable currency relationships. Now let's pull in the retirement and insurance pressure, because that is where forced selling becomes unavoidable. In many countries, aging populations and underfunded pensions create chronic liquidity needs. Insurers sell long-duration assets to meet claims and regulatory capital buffers. Pension-style funds rebalance. And when markets fall, the required rebalancing does not wait until prices recover. In the story we just described, the insurers hold large sums in US dollars, including government bonds and corporate securities. When the US market drops and yields shift, they take losses. Then regulators and risk teams panic. They trigger stop loss or reduce exposure to maintain capital ratios. They sell dollars for local currency to avoid future losses. That pushes the exchange rate higher. And now they face an ironic problem. The exchange rate is moving in the direction that would look good for a long-term holder. But it is moving because the system is in a stress mode. It is moving because liquidity needs are forcing behavior. So the price movement you celebrate is the same price movement that destroys someone else's balance sheet and forces more sales. Now here is the cliffhanger. This is not limited to one island economy. Currency war is global. When one country defends its currency aggressively, others adjust. When a currency strengthens quickly in one place, capital reprices across markets. When the dollar is under stress or when expectations change, the exchange rate impacts ripple. And the people you need to watch are not the retailers laughing at travel deals. You need to watch institutions with large hidden exposure, insurers, pension funds, sovereign-linked entities, and big banks. They do not post memes, they post filings. They manage risk until the day risk management becomes a trigger for self-destruction. Now the next stage is what makes this darker than a normal market correction. This is about transaction mechanics and the inability to exit. Let's say you are an investor in a foreign market. You lose 40% on a stock position denominated in dollars. You want out. You want to convert back to your local currency. But if the local currency has strengthened by 10%, the conversion hurts you again. Your dollar loss becomes a larger local currency loss. That changes behavior. Some people will try to exit anyway, but then they discover something else. Liquidity dries up. Bid-ask spreads widen. The market does not behave like a neat spreadsheet, and if exit is expensive, many investors delay selling. That is how you get rallies that look normal on a chart while underlying flows are still broken. Now connect this to 2026, where artificial intelligence has created a new class of explainers that flood social media with simplistic narratives. People say the market is up, therefore buy. People say the economy is strong, therefore ignore risk. But in reality, you are not just buying stocks or bonds. You are trapped in currency dynamics, in hedging costs, and in a global capital chain. Pattern interrupt a third time. Remember how people used to say the stock market is disconnected from the economy? In 2026, that disconnect is not an accident. It is a feature of how capital flows work when the dollar is involved, when hedges dominate the behavior, and when the biggest players have access to funding that ordinary people do not. When a rally happens, it often happens because big capital is not selling, not because new money believes in the story. In the earlier example, there was heavy volume during the sell-off and then much lighter volume during the bounce. That means the bounce can be structurally weak. It can be a technical recovery without broad demand. If you are living this as an ordinary person, here is the translation. You might see retirement accounts recover on paper, but your job might be shrinking. Your wages might be pressured by automation and by hiring freezes. Your housing might be unaffordable, and your savings might not recover at all because inflation damage did not fully reverse. That is why people feel confused. The charts look better, and their lives do not. That confusion is not stupidity. It is your mind trying to reconcile contradictory data. The system is not designed to match your intuition. It is designed to match its own incentives. Now let's talk about the United States itself, because people abroad often focus on their own pain and assume the US is just the referee. In reality, the US is also a participant. It sets interest rate expectations. It controls a huge share of global dollar liquidity. It can apply tariffs and sanctions. It can influence risk appetite with policy messaging. And when US assets become relatively attractive, capital returns. But when the US has to absorb too much inflow, or when political decisions trigger inflation or volatility concerns, the market starts anticipating stress. Then, big capital moves early. You can see this in the behavior of sophisticated investors and in the patterns of institutional flows. There is a known dynamic in markets. When the largest players anticipate a decline, they reduce exposure ahead of time and build positions where they benefit from volatility. Some do it with cash, some do it with hedges, some do it with currency exposure, and some do it with real assets. In recent years, gold and Bitcoin became popular among those who wanted an alternative to pure dollar exposure, and the Japanese yen became a hedge channel for some investors when volatility rose. But the average person does not get to move early. You usually find out after the change hits your wallet. Now here is where we connect back to the global debt layer, because that is the hidden weight holding everything down. Global debt exceeds $300 trillion. That is not a theory. That is the cumulative obligations of governments, corporations, and households. Debt only works smoothly if refinancing remains cheap and liquidity remains available. In a currency war scenario, the cost of refinancing can change instantly. Bond prices can gap, currency values can swing, and that can turn solvency questions into liquidity questions. Liquidity questions become forced sales become contagion, and contagion does not need a full-blown banking crash to feel like one. Contagion can happen through funding spreads and through currency revaluation of asset portfolios. It can happen through collateral valuation. It can happen through margin requirements. If you are wondering why this is happening now, in 2026, the answer is not a single event. It is the timing of multiple stresses overlapping. Artificial intelligence is displacing middle-class work faster than retraining systems can absorb it. Climate-driven disruptions are raising insurance costs and migration expenses. Housing is locked in high valuations in many places, while wages do not keep up. And inflation, even after coming down, has left a permanent scar on purchasing power. That scar keeps demand weaker and keeps budgets fragile. So while your life gets more constrained, institutions that manage money for a living are making faster and more aggressive moves. Those moves create exchange rate shocks. Those shocks create localized financial stress. And localized stress can force cross-border capital movements that reinforce the cycle. Now we need to be clear about the central metaphor. In a currency war, one side's defense becomes another side's trap. If your currency rises because you bought dollars to defend stability, you might end up exporting your local wealth to the US bond market even when you do not want to. If your currency is falling and you try to stop it, you might burn through reserves. If you let it rise, your exports suffer and your economy slows. Either path creates winners and losers. The problem is that ordinary people are usually the losers. Your job is your paycheck. Your paycheck does not hedge currency. Your rent does not wait for FX. Your bills do not accept explanations. So what does that mean for you right now? It means the passive income dream sold by social media is dangerously incomplete. People talk about investing like it is a personal journey, but in reality, your results are connected to institutional leverage, interest rates, currency values, and global liquidity. If your feed says the market is up and therefore everything is fine, you need to ask a better question. Fine for whom? Fine for the person who bought early and has liquidity to redeploy. Fine for the institution that can roll debt. Fine for the investor that can borrow at favorable terms. Or fine for you when your local currency is moving and your wages are not.
Let's take a micro story to make this real. Picture a 32-year-old nurse named David. He works nights, he has a side hustle trying to learn a skill that will pay off. He did the online courses, the resume upgrades, the AI tools everyone said would make him future-proof. Then his insurance premium went up again, his grocery bill rose, and his apartment rent increased at renewal. At the same time, his retirement account shows small gains. On paper, he feels relieved for a moment, but he is not seeing the macro story. He does not understand exchange rates, bond duration, and currency hedging.
He only knows he cannot cover his rent with optimism. Then a friend tells him the stock market is back, so it must be safe now. David thinks maybe he can finally breathe. He transfers some money, not much, but enough to feel meaningful. Within weeks, his local currency strengthens sharply against the dollar. He converts his savings for investments and realizes he lost value in translation before he even made a purchase. That is the quiet cruelty. You can be right about market direction and still be wrong about your currency and timing. And you feel blamed for not understanding when the real issue is that the system was never designed for your comfort. Now, you might ask, can you do something? Can you protect yourself? This is the sliver of empowerment part, but it has to be honest. There is no magic button. There is risk management, and there is strategy, and there is recognizing what is actually within your control. The first control is behavior. Do not confuse price movement with real recovery. In a stressed environment, you can get sharp rebounds that do not restore your underlying risk position. You might see a recovery while your ability to exit remains impaired. You might see green charts while your currency conversion continues to hurt. The second control is diversification across the dimensions that matter, not just stock versus bond. Currency exposure, liquidity needs, and the match between the asset and your future spending currency are what matter. If your future spending is in your local currency, then you should understand how your portfolio behaves when your local currency strengthens or weakens. A portfolio built only around one country's assets can become a foreign exchange trap. The third control is understanding that holding cash can be a form of power, not because cash is exciting, but because cash is optionality. When markets get unstable, optionality is what keeps you from being forced to sell at the worst time. In many environments, short-term liquidity becomes the difference between survival